Hey folks, Labor Day, I'm sad to say, is over. Wall Street's summer vacation is also over. It is time to strap in as we begin this latest episode of the What Does It Mean podcast. I'm Chris Versace, and joining me is Bob Lang. Lindsey Bell, however, is squeezing off a last bit of vacation. Now, Bob, you and I have known each other for a long time. I don't want to get too bogged down into this, but I do know you had a very extra special Labor Day weekend. You made the trek to Queens, New York, and you went to the U.S. Open, correct?
I sure did, Chris. It was a great day. We got up early in the morning and drove to New York City. Fortunately, there was no traffic on the way there, nor on the way back. We did leave a little bit late, but anybody who was driving on a Sunday morning at 6 o'clock in the morning, pretty foolish. But listen, you know what? We did what it took to get there and had a great time.
So I just want to know one thing, Bob. Your presence in Queens at the U.S. Open, sponsored by American Express, did you jinx the person you were hoping to see win or not?
Oh, no. Everything pretty much fell in line. We watched some great tennis at Louis Armstrong. There were 4 matches there during the day, and the weather was pretty good. It was a little bit hot, but no, we didn't jinx anybody. Everybody who was expected to win ended up winning, and it was a fantastic day. And there's more tennis, of course, later on this week, and we're looking forward to seeing who makes it into the finals, and
agreed. I'm curious to watch it as much as I'm anxious to watch the data that we'll get this coming week, because it's going to be important. It is too bad that Coco is out, but it's the way it goes. So one other quick question, Bob. Did you see a lot of people? This is key because we're going to talk about some wacky recession indicators later on in the show. When you were walking up and down through the stadium, you see a lot of people sucking back those big $22 honeydew drinks that they were selling there at the Open?
Well, actually, yes, I did. I mean, there was quite a few people that were putting the drinks down, and there was, a couple other different varieties as well, too. But I think that honeydew is the one that was most favorable. And I saw a lot of huge lines, Chris, for at the bar for the cocktails and for drinks. And if that is an economic indicator, then I think that we'd have to say the economy is in pretty good shape. People have some money to spend and to buy a $26 drink that they get to take home with them, a plastic cup. That's
whoa. Did you say $26 for a drink?
$26 for the honeydew. And it was, what is it? It's vodka with lemonade and a raspberry liqueur with a couple little honeydew balls inside of that. So it's really sounds. But for $26, it was kind of expensive.
That sounds like a high margin drink. That's what that sounds like. All right, Bob, let's get down to business now that we're all back in. And as I said, summer vacation is over. As we get ready to really move into the last month of the current quarter, I think August surprised people, right? If you think about how we started it off with the markets kind of, sliding, becoming overbought and then rallying back. The S&P 500 closed about 1.6% higher, about 3.4% for the first 2 months of the current quarter. But you and I have talked, Bob. You've heard me say that the PE valuation for the S&P 500 is so far getting stretched again. But I've also heard you say that that market barometer that a lot of folks pay attention to is overbought. My question to you as we move into September, is it still overbought? And what does that mean as we go forward?
Well, Chris, I think the large majority of indicators that I look at are somewhat mixed right now. Some of the indicators on the price indicator side of things tell us that the market is pretty well overbought. Yet, if you look at volume trends, they've been really down. And as expected during the month of August, we don't see a lot of volume. A lot of traders and investors go on vacation for the month of towards the end of July into the end of August, and they start coming back at the beginning of September to take their spots and start doing some trading. But by and large, I'd say that the market trends have been skewed towards an overbought reading to the upside if they follow the price action. Now, we've been really kind of in a range for the past couple of weeks, and I suspect that once big traders come back from the vacation, we're going to see some momentum moving in one direction or the other. And historically speaking, September has been a tough month for the bulls, no question about it. And we may see some downside here. The S&P 500 teased right up against the all-time high, which was back in July, just a few days ago. And perhaps we'll see some of that burn off, that overbought reading from the short term burn off down towards the moving averages, and see if there's some support down there. But frankly, Chris, I'm worried about September. We've been up 7 out of the last 8 months. A good friend of ours, Tom Lee, came out this past couple of days ago and said he could see the markets correcting 7 to 10%. So I'm not sure. The bears are saying from his lips to God's ears. Who knows?
Okay, so you're saying the permabull, known as Tom Lee over at Fundstrat, is kind of sending a flare. All right, well, that's going to help frame the conversation that we have for today's show. We'll be talking about this week's August data and why it could make or break the month of September. We'll also be reviewing some wacky recession indicators that we've been reading about, and we'll be sharing our thoughts with you about Apple's big event next week. All that when we return. Stick around. All right, Bob. So it's just you and I digging into the meat of things this week. As I said, Lindsey is on vacation. Lucky her, squeezing it in. But, Bob, you and I had talked about a few moments ago, but even more so, that September and October, typically very challenging months. When I think about September being a tough month for the market, I think that it's, the junior league, so to speak. They're back on the bench where they belong. The primetime players are back in action. But we also tend to get a real wave of September investor conferences where management teams kind of come out and they take all the data that they've gotten since they last reported, kind of update investors with what their current thinking is for the September quarter. But then they also kind of refine expectations for the balance of the year, meaning the all-important fourth quarter. We've got a lot of data over the last few weeks about the manufacturing economy slowing, about consumers being even more selective than what we were thinking. I think it kind of sets up the fact that companies could become a little more conservative with their outlook in the next couple of weeks, possibly weighing on the market. And I know you were saying before we jumped to this part of the show that you were a little concerned about September.
Yeah, and I certainly agree with that. I think that the concern that some of these companies have, they voiced it when earnings started to come out in the early part of July. We did have some companies that did forecast some lower earnings expectations and kind of pulling back the curtain on what they're doing into 2025. You mentioned to me not too long ago that earnings expectations are extremely high for 2025 and still haven't come down as much. And I think you said you were looking at double-digit growth in earnings. Was it 11 to 13%?
No, it's 15%. And you're right, it hasn't come down. It's kind of stayed at that elevated level, even though growth expectations for the second half of 2024 have softened compared to the first half of the year. So it's almost as if it's looking for a reacceleration in earnings power going into 2025. And look, some people might be thinking that, oh boy, the Fed is going to pour on the stimulus juice, right? And maybe that will help reaccelerate the economy. But, Bob, as we sit here, we're just starting to get the all-important August data, right? And this week is very important, in my opinion. We're going to get a lot of data about the speed of the economy, job creation, wages, inflation. And if we just look at the timing to the Fed's September 18th meeting, very short window. I really do think that this week's data can make or break expectations for what the Fed is going to do, and that will make or break the market in September.
I can't disagree with that, Chris. I think that really the data that the Fed is concerned about here is surrounding employment, and they've pretty much given up on trying to fight inflation with both barrels. And what I mean by that is inflation is starting to come down towards their goal. It's been coming down for the past 16 months, but making a move towards that 2% goal or objective is almost where the Fed feels like their job has been done. Now, the problem that they have here right now is a strong jobs report. A jobs report on Friday, September 6th, is going to throw a monkey wrench into their plans. And I think, by and large, they've been taking a much more conservative approach as it relates to monetary policy. they don't want to really throw so much gasoline on the fire, as you said, to start another inflation cycle. That's going to be even more difficult. The main point here is that the market has simply gotten ahead of where the Fed is at once again. It happened earlier in 2024. It's happening again right now. I think the market is looking for 4 rate cuts in 2024. We only have 3 meetings left. So obviously one of those meetings is going to be a double rate cut of 50 basis points, possibly even more in 2 meetings. Who knows what the combination that the market is looking at right now? I think it's looking at 2, 1, and 1 by the end of the year. The Fed is certainly not in that camp, Chris.
No, it's not. It's definitely not. And I think if we look at the data coming into September, the Atlanta Fed GDP Now model, granted it's a rolling forecast, it'll get updated as more data comes in, pegs the economy at a 2.5% GDP level. Not exactly something that, the Fed needs to throw a life preserver to, right? I think it's somewhere between the soft landing, no landing scenario. But, again, we are starting to get some of this August data in. And I have to say, Bob, that the ISM manufacturing PMI report for August, not exactly encouraging. It shows for another month, the manufacturing side of the U.S. economy is contracting, hiring is slowing, and at the same time, prices are, ticking higher. That's not a good message for the Fed.
No, it's not. And frankly, the worry that the Fed has right now is that there's going to be too much of a slowdown, Chris. And if the market and the economy is slowing down too much, are they going to have to come in with a much more aggressive stance? I know that, with a pretty much 100% certainty, that's not what they want to do. But, again, they're going to interpret the data as it comes in and make adjustments to policy as they have been talking about for the past several months. I do think that a rate cut is probably in the cards at the next meeting and certainly being priced in. I don't think a double rate cut, which would be 50 basis points, is going to happen because the Fed is much more gradual in their approach, and they need to stick with their words and their knitting. Even last week, what we heard, Raphael Bostic, who is a voting member, Atlanta Fed president, did say that, look, I'm still in maybe the 1 rate cut camp, maybe 2, but he really wants to see much more of the data coming in to confirm that they're going down the right path with a rate cut change in policy.
Yeah, and I think under Powell, these guys have been trained to really telegraph well what it is that they are likely to do. But again, I just want to get back to this week's data because, the A team is back playing the field, and we've got data on the manufacturing economy. We've got data on the services economy, job creation from ADP, of course, the employment report. My concern here is that folks read a little too much into the manufacturing report. I mean, as you and I talked before we were taping today, Bob, the manufacturing PMI from ISM has been contracting for 11 out of the last 12 months. Not exactly new news. So to me, the bigger risk is on the services economy, which has really been keeping the U.S. economy alive and growing. So if we see that report throw up some warning signs on Thursday, September 5th, that's going to be a little more concerning for me. But I also think the other setup that we have this week is expectations for the August employment report. They're hovering around 165,000 jobs, let's call it, up from around 115,000 in July. So on the one hand, you would say, boy, big acceleration number. That's good for people, right? More people are working, more people have a little extra to spend, but that would be potentially negative for the market because it could tell the Fed that, you know what? The employment market is okay. It's not rolling over. It's not a warning sign you need to have right now.
Well, I think the interpretation by the Fed of a strong labor market is a concern that down the road that it's going to lead to some increase of inflation. Now, me being an advocate of what's known as the Phillips curve, which means that wages tend to help increase inflation down the road. Now, call me old school, Chris, but there's a lot of people out there who have tossed out the Phillips curve, which was created back in the 1950s and 60s, looking at the relationship between wage growth and inflation. Not even the Fed, not even Chair Powell will give 2 bits to what the meaning of the Phillips curve is these days. But still, I think that wages are a chief concern for the Fed right now, for the committee, in talking about future inflation, there's a huge lag effect from the jobs report and from inflation in wages. And if that ends up rising precipitously over the next, several months, we haven't really seen much of a control over the wage growth that we've had over the past, 2.5 years. It's been growing steadily for a while here. If that doesn't get under control here, it's going to be a concern, and the Fed is going to probably tap on the brakes from an easy monetary policy in 2025.
So it's fair to say that when we sift through the ADP employment report for August, Bob, in addition to the number of jobs created in the private sector, they also have some wage data, both for job stayers and job changers. Job changers has been running anywhere from high single digits to low double digits over the last year. It's been coming down, but it sounds like that's a data point that you'll be kind of focused on.
Yeah, that's the wage number, unit labor costs, productivity coming out on Thursday of September 5th as well, too. Those are key numbers that I'm going to be paying attention to in front of the Fed meeting, which is coming in about 2 weeks.
Okay. So as it relates to the August employment number, that 165,000 jobs added, do you think there's room for disappointment? I do, and I'll tell you why, but I want to hear what you think.
I would ask you, what's disappointment? Disappointing to the high side or disappointing to the low side?
A question with a question. I love it. Disappointing would be a lower than expected number such that it worries the market.
So we did have one of those in August. The July employment report was largely a miss. And then, of course, that was right around the time when we had that whole yen carry trade shenanigans going on. Markets tanked on the Friday before all that happened, the prior price. So really, we do have a data point there, Chris, that said that, how does the market respond to a miss in the jobs number? And it actually happened on, I want to say it was August 3rd or August 2nd for the July jobs report. So if we do have a miss to the downside, we possibly could, especially with the markets up where they are right now, we're only within, 2% of an all-time high in the S&P 500. The Dow Industrials recently hit a new all-time high. I think that what you're looking at is you're looking at it correctly when it comes to what is the market response going to be, and if the number is poor, it's probably going to be to the downside. And we've had that happen, even if there's some adjustments from the July number and the June number that came out the last 2 months. So I think you're spot on there.
Yeah. So the whole reason I'm a little concerned about the August employment report relative to expectations, it's that 165,000 number, is when we sift through some of the other data, whether it's the flash August PMI report from S&P or what we've seen so far just on the manufacturing side from ISM or S&P Global's final manufacturing PMI for August. Man, that is a mouthful to say. But when we aggregate those comments, it shows a pronounced slowdown in manufacturing hiring and a real softening on the services side of the economy. So I do think, it's possible that the August employment report maybe is more in line with what we saw in July. That would be a big miss for the market. I think it would incorrectly, however, stoke market expectations for that 100 basis points in rate cuts that you talked about. I said it when we talked about the July employment report. If we see an August employment report north of 100,000 jobs, it is not the worst thing in the world, not something to light your hair on fire. But Bob, why don't you wrap this all up so we can move on to something a little more lighthearted, because this sounds like it's getting a little negative Nancy here.
Yeah, I think that, 100,000 to 120, 160,000, which was the expectations for the September 6th report, it's not a bad thing. And, and we're creating jobs. We're not losing jobs. So, and I think some of the data that we've noticed from some other reports, not just the ADP, but also the JOLTS data and the jobless claims, have indicated that the job market still remains pretty robust and pretty strong. And the Fed has not had any concerns about the job market. They're just worried a little bit about if the job market overheats. So I think by and large, this jobs report could go a long way. As you mentioned earlier, this important data this week is going to tell us where we're going to be going over the next 4 to 6 weeks. And don't forget, September, October have been notoriously, historically bad months for the markets, especially in October.
Bob, you are right. There is a tremendous amount of data out there, some of it useful, Some of it insightful, some of it far less than that. And sometimes, I come across stuff that I got to be honest with you, I just scratch my head wondering, what are these people thinking? And I was doing some of that over the weekend because I stumbled across an article that talked about wacky indicators that a recession is coming. And, it's kind of timely. I understand that folks want to have like a leading indicator of a recession, even though you and I both know that 90% of the time, if not more, we don't know that we're out of a recession until it's over. So, people want to kind of try and triangulate. I get it. But with that in mind, I just wanted to run some of these past you to see kind of what you're thinking, and I'll share my thoughts as well. What do you say?
Sounds good, Chris. Hit me with it.
All right, folks, Bob's wacky indicators. Here we go. So number one, Bob, lipstick and other cosmetic sales. The thinking is that as we go into a downturn, women may not be buying as much lipstick. They may not be buying as much cosmetics. Kind of like, if you think about it, when things are a little tighter, guys might stretch out their haircuts. What do you think?
I get that. I understand that. Cosmetics are a discretionary item for a lot of women. But certainly buying the cosmetics could mean that we're heading into a much more stronger, robust period. Certainly, if the jobs report is starting to turn, we've had a good, strong job report for a while. We did see some good, strong earnings a couple of years ago, Estee Lauder and Ulta, which tells you that during a strong upturn, which we had right after the pandemic took hold, Chris, in 2021 and even 2022, we had a good, strong, robust jobs report month after month. These companies here actually produce some good, strong earnings. So I do think there's a good, strong correlation here between this lipstick and cosmetic sales and a strength in the economy. Some years ago, Chris, I used to follow something called the Winnebago indicator, which said that when Winnebago sales are strong, it tended to correlate with a strong economy as well, too. So I think it's in a similar vein. It's all very well connected.
Yeah, I hear you, but I think, to be fair, that the pandemic and coming out of it kind of might have jostled around these as real valid indicators. And as far as lipstick, cosmetic sales, or even haircuts, I don't know that it's the economy per se so much as it might be the jobs market. Because if you're getting a job or you got to go into the office, you kind of got to get cleaned up, prettied up, let's say. All right, let's move on to the next one. Tipping. Now, this is an interesting one because, you would think that conceptually, when times are good and people are feeling flush, they might be a little loose with the purse strings. But as things kind of tighten up, or the economy appears to be slowing and, there's some concerns percolating, this tends to have a self-fulfilling type of prophecy, Bob. Tipping may not be as robust. You may not give 20, 25%. You might shorten up to 15%. And by the way, forget those carryout people. I got this food myself. What do you think?
We could have a whole nother podcast just talking about the efficacy and the changes that have come around the whole tipping business, but we won't.
We could do that. I'll let you and Lindsey do that one time when I'm not here. How about that?
That sounds great, Chris. But as far as tipping is concerned, yes, I think I agree with that. When it seems like people are a little bit more flush with cash, when they are feeling much more generous, or even, during the last couple of years in the pandemic, when, my feeling was is that, people are working hard. They're doing a good job trying to satisfy their customers, satisfy the businesses that are out there. They're worthy and deserving of a good sized tip. Now, these days, I think the tipping is a little bit more, it's a little bit more outrageous as far as I'm concerned. I think a lot of companies
now, let me cut you off there. Is that because, going out to eat is that much more expensive? And you and I have talked about this, the price of drinks as adult beverages, cocktails, what have you, have skyrocketed.
Well, there's that too, but also there's a lot of, you get the check, you get the bill, and there's all these other fees and charges that are involved in there. Oh, no, by the way, you have to tip on top of all those charges. And it's got a little out of control if you ask me. But I do think that and people are feeling a little bit more secure about their job and they go out to eat or they go out to any certain places as well too. Listen, one of the things that we like to do when we go out to a hotel, we like to be very generous to the person at the door, the person trying to take in your car, maybe the housekeeping people who are cleaning up at your room, that sort of thing. I think the generosity of people tends to come when things are good and businesses are strong and the job market is strong as well too.
All right, let's leave that one there. Let's move on to the next one. I can't say that I agree with this. I'll say what it is, then I'll give you the rationalization, but I think you might have a more interesting take on this, Bob. Dating app usage. And the way it was explained is that as dining becomes less popular because people are concerned about spending during a slowing economy or recession, that people turn to digital dating to meet people. What do you think?
I completely agree with that. I see that happening, and certainly dating app usage has been strong for the past 5 to 7 years. We didn't really have dating apps 20 something years ago, but now they've kind of gotten in vogue. There have been some new apps that are out there like Bumble that are very, very popular, and I think that more people are willing to use these apps to match up with somebody more often when they're feeling good about things, when the recession is starting to hit, when money is starting to get tight. This is one of those discretionary items that people are going to cut and say, look, you know what, I don't really need to do that. I'm going to go old school and just go to the bar or go to a restaurant and try and meet somebody.
Or go out with friends.
Or go out with friends. That's right.
Yeah. I tend to agree with you on this. I think that, if you're worried about a recession, I think this is all part of the subscribership or subscriptship, I should say, economy that we have today when, streaming applications, getting your dog food or pet food through Chewy, Amazon, all these subscriptions that people have amassed. I think that when times get tough, folks are going to sit back and say, geez, do I really need this? Do I really need that one? Maybe this is one that may or may not make the cut. But as far as indicating a recession, I'm not buying it. All right, Bob, our last one, business disputes. And the notion here is that as difficult times kind of approach, we can see an uptick in private company insolvencies, partner fights, business disputes, and the like. I kind of think this is something to pay attention to. If the economy is softening or worse, not everybody has the same economic situation, especially as a business that they may have to support, might need a little bit of help. What do you think?
No, I agree with that. And I certainly, one thing I learned many years ago was investing in companies that are struggling in an environment when the economy is starting to slow down severely or possibly getting into a recessionary mode. It's not a good time to be investing in those names, especially with the risk of bankruptcies coming out. But coming out of a recession certainly is where you want to be investing in some of these small businesses because the risk of bankruptcies falls significantly as we come out of a recession and we start into another boom cycle. So I agree with you. I think this is certainly something to be paying attention to carefully, especially if we're at the tail end of a long economic boom cycle, and we tend to move down into a more of a, I'm not going to say a bust, but more, I think the language that we've been using lately is softer landing, not necessarily the soft landing, but softer landing than most have been expecting. But certainly I think that being the case, pay attention to some of these business disputes that are going on because people are going to fight for every dollar they can get.
I agree. All right, let's wrap this up and get ready to move on to our third topic. But from the second topic that we just talked about are wacky indicators that a recession may be coming. I think you got to be really careful in understanding any indicator that someone puts out there. What are its pros, cons, shortcomings, and really how and when to use it. We like to say that there is no silver bullet. Clearly, that's true with hard economic data or even this softer economic data, including some of these indicators. Let's move on, Bob. Just given the way that our podcast is published, we tend to come out on Thursdays. That means this will be the last chance that we have to talk before Apple's big event next week. And Apple, it's one of those barometers you have to watch. The why, well, there are a few of them, but probably the biggest one for most investors is It's the number one holding in the S&P 500, and it's a top 1, 2, or 3, depending on the day, holding in the NASDAQ composite. That also means the same thing for the NASDAQ 100. So this is an event you have to watch. And there's a lot of expectations for this event, right? This is where Apple's not only going to unwrap the next iPhone and some other devices, but it's the time when they're really going to show Apple Intelligence, their iteration on AI. A lot of questions about this. This event, if it wows and says, man, this is a hot device, you've got to upgrade to get this latest stuff. Because only these models on I believe it's the iPhone Pro 16 and the iPhone Pro 15 will be able to use Apple Intelligence. It could really foster in a big upgrade cycle. And there are folks out there who say that over the last 4 years, about 300 million plus or minus iPhones have not been upgraded. So this is a big deal. Here's my question to you, Bob, because I did a little homework. I know you have an iPhone 12. What is it going to take Bob Lang to open his wallet and upgrade to an iPhone 16 Pro?
Well, maybe a couple of new features here and there, Chris, but what is the one thing that everybody pays attention to with a new phone? It's the camera, right? Everybody wants to know what are the new functionalities with the camera. But I did hear famed technology analyst Gene Munster this morning say that he thought that this particular cycle and this particular event next week, Chris, is the most important one that Apple's had in 10 years. So I think I want to say 10 years ago was right around when they introduced iPhone 3 or iPhone 5. So, or maybe iPhone 6. Okay, thank you. So again, the hype and the energy and the expectation here on this event is reaching heights that we haven't seen in that period of time. I was also curious, thinking about something, Chris, about the last segment that we talked about with the wacky recession indicators. Why wouldn't Apple iPhone be on that list too? Shouldn't it be? I mean, if people are not stepping up to buy a new iPhone, is it that inelastic of a product that people need to have their iPhones, regardless of what their price is? Chris, what if the price of the new iPhone is $1,500? I think people were having a hard time 7-8 years ago saying that, oh man, $1,000 for a phone, that's way too much for me to buy for a phone, but people have been buying it anyway. What if the price gets jacked up to say $1,500, $1,600, and that's with or without some sort of discounts from carriers? Who knows, right? But I'm wondering that why isn't the Apple, the iPhone on that recession list? And certainly if the numbers are not as people are expecting, what is that indicating, softer times ahead?
So your question is, why shouldn't Apple and the iPhone be an indicator for a recession? Meaning that if folks are spending, if they're flush, good times ahead, but if people are pulling back, not upgrading, possible concerns. Yes?
Correct. That's right.
Okay. So I think that it's a tough one to answer because this iPhone that I hold in my hand is my connective device. I take it with me everywhere. It lets me do anything and almost everything that I want to do in my daily life. Stream, talk, message, capture pictures, as you said, with the camera, and, conduct financial transactions. I can get work done on it, all sorts of things. So the utility in that device is significant. But I do agree with you that we have seen, at least in the States, since carriers are no longer subsidizing a new phone every 2 years, that the replacement cycle has kind of extended itself. So I think it's a real tough one. I think it comes down to how consumers are feeling. Maybe you're not about a recession, but I think folks want to have the new thing. It's a little bit of a status symbol. So I think it would be a murky indicator at best. But I will say this, though, that I do think that for this replacement cycle that everybody's talking about to really kick off, Apple needs to show some really over-the-top, compelling wow factor, hit it out of the park, knock the cover off the ball, use your euphemism, examples of how everyday people can use Apple Intelligence in their lives, right?
Don't you think that every single time they come out with a new iPhone, that hype is up there, and you have to kind of
No, I do not. No. I think there's a big expectation this time because there's a lot of emphasis being put on Apple Intelligence as driving this long-awaited, very large upgrade super cycle. And if they fail to do it, then I think folks are going to be questioning AI all over again. And if the enthusiasm isn't there for Apple Intelligence, it means that expectations might have to be lowered for iPhone sales. There's been a lot of chatter out there that Apple's upping their orders, right? So the onus is really on Apple to deliver. I will say that they are excellent at stewards of the user experience. And if anybody's going to do this, it will be them. But I will also say that I think that some of these corporate presentations under Tim Cook have kind of fallen flat. They've gotten a little jokey, right? With some of the, skits that they perform. I would much rather have good old Steve Jobs back in the saddle doing a one-man show, wowing the crowd. So as much as I would be hopeful that Apple is able to pull off a win, and I think they could, I do have some doubts, as you can see.
Yeah, and you're not the only one who has some doubts. I think Warren Buffett came out and sold several shares of Apple in the last 13 KF filing. So
are you telling me you're taking your cues on technology adoption from Warren Buffett?
Listen, the guy is great timing, and the shares that he sold were up 1,000%. Actually, and he bought Apple late in the cycle here. I think they started buying Apple in 2017. So with a 10x return on investment there, I'll take that as a cue that he's a little bit concerned going forward. Because, here's a guy who just turned 95 years old on Friday and says that I will hold stocks forever.
Are you following his diet of Coca-Cola and candy and McDonald's?
No, but I probably should.
All right, let's wrap up this third segment. So, our thinking is that Apple has a lot riding on this event next week, the big Glow Time event. That'll be September 9th. If Apple can indeed wow the crowd, make the case that folks do need to have and be users of Apple Intelligence, it could foster in a massive super cycle, upgrade cycle, which would drive not only Apple shares higher, but also those that are surrounded and encompassed by the Apple halo effect, i.e. key suppliers. All right, stick around. We'll be right back to put a bow on this week's podcast. All right, Bob, let's talk about it. Give me the one thing that you learned from our conversation this week that kind of made you go,
Well, Chris, it'd have to be the wacky recession indicators. That was the most interesting group of ideas that I've heard in quite some time. And it was all mostly surrounding the consumer, which, no surprise, is about 70% of the economy is a consumer. When you talk about lipstick sales, dating app usage, tips, those are all really focused in on the public, on the consumer, and spending, discretionary items, so forth, and even more non-discretionary items too. So I thought this was the most interesting one as to indicating whether it's a leading indicator for a recession or not.
Any one out of those that you think is, one to watch?
Yeah, I think it's the dating app usage one. I think that's the one we really have to take a look at, because if consumers are flush with cash and they're spending money on a dating app, they're spending money on going out and spending money going out to dinner, going out to the movies, and going traveling and that sort of thing. That's the one app that I think that hits at the heart of spending, discretionary spending for consumers.
Fair point, Bob. I was going to get ready to push back, but then the way you explain that, I can see where you're coming from. I think the big thing for this week is just remembering that September, October can be very challenging months for the market. We've got to be mindful of investor expectations and how far they may or may not be separated from what the data is telling us. I think in this instance, the notion of 4 rate cuts by the Fed before the end of the year, or 100 basis points across 3 meetings, I'm still concerned about it, but I know that to be a good investor, you have to be active, not trading, but active and constantly refreshing your views as more data is had. And of course, when we get back with next week's podcast, we'll be able to recap all of this week's data in full and talk about how any changes have come about as what we think the Fed might be doing on September 18th. So with that, I'll put this episode down for the count. Thank you, Bob, for joining me. Next week, Lindsey will be back. We'll have a lot more fun, a lot more insight. Thanks for listening, and we'll see you soon.